Meta stunned Wall Street on July 30th, 2025, reporting Q2 revenue of $47.5 billion, up 22% year-over-year, and EPS of $7.14, well above the $5.89 expected. Ad sales climbed 21%, driven by higher prices and growing engagement on Facebook and Instagram. Crucially, Meta narrowed its full-year capital expenditure guidance, signaling disciplined spending even as it pours cash into AI infrastructure. The market responded instantly. Meta shares jumped 11% in pre-market trading, making it one of the day's biggest gainers. Options volume surged by 40%, suggesting investors are positioning for further upside. Trading sentiment was euphoric, but some hedge funds noted the rally may have priced in too much optimism. Behind the scenes, CFO Susan Li highlighted cost efficiencies in Reality Labs, Meta's AR/VR division, and teased an upcoming AI-powered ad toolkit set to roll out in Q3. That roadmap cemented investor belief that Meta's long-term growth will be driven as much by machine learning-driven ad products as by its core social platforms. Despite the enthusiasm, bears warn of rising competition in digital advertising. Snap's ad revenue grew 38% in the same quarter, and looming regulatory scrutiny over data usage practices. Still, for now, Meta's combination of sheer scale, cash flow generation, and AI capex control has quelled near-term worries. Meta's journey from a college startup social network to a global tech powerhouse is extraordinary. Founded in 2004, Facebook became the world's largest social platform by 2012, with Mark Zuckerberg at its helm. Over the next decade, Meta expanded into Instagram, WhatsApp, and Reality Labs, its AR/VR arm. Yet growth slowed after 2018, when user fatigue and data privacy scandals triggered multiple ad revenue declines. In response, Zuckerberg shifted strategy toward the metaverse, pouring $20 billion annually into AR/VR research. Critics question the payoff. Reality Labs' losses topped $14 billion in 2024 alone, costs that weighed heavily on Meta's bottom line. Recognizing the need for a new catalyst, Meta refocused in 2025 on AI-powered advertising, leveraging its vast user data to train ad optimization algorithms. Early pilots reportedly increased return on ad spend by 15 to 20% for major brand clients. This pivot resonated with investors, who saw AI as the next monetization frontier. Meta also invested in foundational models, aiming to compete with Google and Microsoft in generative AI. Partnerships with OpenAI and its own in-house research labs have accelerated feature rollouts across Messenger, Threads, and Ad Manager tools. While Meta's AI ambition is grand, execution risk remains. Building large-scale models requires massive GPU capacity, and global chip shortages could hamper progress. Moreover, deploying AI responsibly invites fresh regulatory scrutiny. Europe's AI Act is set to impose strict data usage standards by 2026. Meta's earnings rippled through Wall Street and Silicon Valley alike. Goldman Sachs upgraded Meta to buy, citing clear evidence of AI-driven revenue acceleration. Morgan Stanley raised its price target to $420, noting that Meta's ad toolkit could reshape the digital ad market. Meanwhile, Snap and Pinterest stocks also climbed on the news, lifting hopes that AI ad enhancements could benefit other social platforms. Snapchat's ad revenue forecast was revised upward by 5% after management hinted at its own AI features rollout. Not everyone joined the chorus. JP Morgan analysts called the rally overcooked, highlighting intensifying competition from Google, whose AI-enhanced search ads command a 30% market share, and TikTok, whose bite-sized video ads are winning younger demographics. Regulators weighed in too. The Federal Trade Commission reportedly asked Zuckerberg's team for details on data-sharing agreements with AI partners, probing whether the pivot could breach privacy regulations. In Europe, EU antitrust enforcers are watching to ensure Meta's AI tools don't stifle competition. At the same time, internal whispers at Meta suggest cautious optimism. Senior engineers acknowledge that while AI can boost ad yield, the true test will be user sentiment, whether more personalized ads will erode trust or engagement over time. Meta surveys show 65% of users welcome smarter ad recommendations, but 35% fear creepy inferences. Meta's surge has triggered broader movements across the tech and ad tech ecosystem. NVIDIA, the GPU leader, saw its shares rise 6% after a blockchain beat report noted increased AI infrastructure orders for Meta and peers. AMD and Intel also caught a bid. Ad networks scrambled to pitch AI upgrades. The Trade Desk announced an AI for Ads package promising 10% higher ROI, banking on Meta's momentum to drive enterprise demand. Meanwhile, smaller ad tech startups specializing in first-party data analytics saw 20% upticks in venture capital inquiries. Media agencies are retooling too. Global firms like WPP and Omnicom held emergency strategy sessions to integrate AI-powered ad buys into client pitches, aiming to match Meta's new offerings. Marketers now face a choice: ride Meta's AI wave or risk falling behind in performance-driven campaigns. Beyond ads, Meta's stock move has reinvigorated the broader, Magnificent Seven FANG stocks, lifting indexes by 1.2% on July 30th. The S&P 500 climbed to new highs, fueled by optimism that AI-driven growth can offset macroeconomic headwinds. Yet volatility looms. Rapid multiple expansions. Meta's forward P/E jumped from 20x to 25x, could reverse sharply if AI rollouts stumble or privacy rules tighten. Some hedge funds have already initiated short positions on high-beta ad tech names, betting on a correction once the AI hype premium fades. Meta stands at crossroads. Its Q2 beat and AI spend discipline have re-earned investor trust, but the path ahead is fraught with both promise and peril. On one hand, AI ad tools could unlock $100 billion in incremental revenue over the next 3 years, fueling new content formats, commerce integrations, and immersive ad experiences in the metaverse. Higher margins from AI efficiency could also boost free cash flow, funding future bets. On the other hand, the same AI capabilities that power personalized marketing raise potent governance questions. Who owns the inferences made about consumer behavior? How transparent are algorithmic decisions? And can Meta navigate an evolving patchwork of privacy laws? California's CPRA update, Europe's AI Act, India's draft Digital Personal Data Protection Bill. Without repeating past missteps? CEO Mark Zuckerberg has vowed to balance innovation with responsibility, pledging quarterly updates on AI safety measures and user control features. But critics argue that Meta's track record on privacy and ethical AI remains mixed at best. For investors, the choice is clear. Back a company that dominates social media, builds leading AI infrastructure, and generates $20 billion in quarterly free cash flow, or hedge against a regulatory crackdown and competitive onslaught. Meta's stock rally in July 2025 is more than an earnings story. It's a barometer of how Wall Street values growth powered by cutting-edge technology against the backdrop of an increasingly complex regulatory and societal landscape. The real question isn't whether AI can drive the next leg of growth. It's whether Meta can deliver it responsibly and whether investors will reward that balance in the quarters ahead.